In this video, you'll learn about stock dividends, what they are, and how they work in the investment world. Many investors are confused about the concept of stock dividends and how they differ from traditional cash dividends. This confusion often stems from a lack of understanding of the basic mechanics behind stock dividends. To clear up any misconceptions, let's start with the basics. Stock dividends are often seen as a way for companies to reward their shareholders without having to make a cash outlay. The mechanics of stock dividends are actually quite straightforward. When a company issues a stock dividend, it's essentially distributing more shares to its existing shareholders. This can be done in two main ways, either as a percentage increase in the number of shares owned or as a fixed number of shares. For example, if you own 100 shares and the company declares a 10% stock dividend, you'll receive 10 additional shares. The benefits of stock dividends for shareholders can be significant. For one, they provide a way for companies to reward their investors without having to pay out cash. This can be especially beneficial for companies that are looking to conserve their cash reserves. Additionally, stock dividends can also increase the liquidity of a company's shares, making it easier for investors to buy and sell. The potential impact of stock dividends on stock prices can be a bit more complex. Generally speaking, when a company issues a stock dividend, the price of its shares may decrease slightly due to the increased supply of shares on the market. However, this decrease is often minimal, and the overall effect on the stock price is usually negligible. The key takeaway is understanding how stock dividends can serve as a strategy for companies to reward shareholders while preserving cash. By issuing stock dividends, companies can maintain their cash reserves while still providing value to their investors. This can be an attractive option for companies that want to keep their cash on hand for future investments or other business needs. Stock dividends can also play an important role in investment strategies. For income-focused investors, stock dividends may not seem as appealing as cash dividends, but they can still provide value in the form of increased share ownership. For growth-oriented investors, stock dividends can be seen as a sign of a company's confidence in its future prospects. To wrap up, stock dividends are a unique way for companies to give back to their investors, and they play an important role in investment strategies. If you found this video helpful, be sure to check out our video on the differences between cash and stock dividends, and leave your thoughts in the comments below.